All right, so today we're going to talk about mutual funds. We talked about stocks and bonds last time, and yeah, the likelihood of you guys owning stocks and bonds, you may if you're kind of into investing and choose to do it. It's far easier than it used to be. There's all the clunky, having to buy in lots and use brokers and pay commissions. All that stuff's kind of gone away. So it's certainly within your grasp if you have the desire to easily buy stocks. But mutual funds are always going to be a big deal. So mutual funds are typically comprised of stocks or mutual funds, but they're managed by there's a fund manager. Now, obviously, if you've done that podcast assignment, you realize that there is kind of a trend, especially when the market was super strong, to go in more of a hands-off management kind of style where there wasn't much management, wasn't any buying and selling. They just did, say, an index or something like that and called it good. But it's probably going to revert back to more hands-on managed mutual funds because the market now is going to be quite a bit more challenging, and you just can't throw money in the market and hope for it to go up. So anyway, but I would argue that just about everybody, regardless of what you're involved in, what you decide to do for a living, you're going to be involved in mutual funds, like it or not. Even if you said work for maybe a union, or you're going to be a school teacher or something. Anyway, pension funds that's what they live on. They're in mutual funds. You're already, if you're getting the PFD, you're in um, more or less a mutual fund. They sit there and manage the PFD fund, which is, people are under this misidea that's directly based upon oil revenues. Nope, they got the money from oil revenues, but it's largely a lot of real estate. And it's funny, the company that I still work for, that's based back in D.C., a lot of the real estate they're located on is actually owned by, or some of it's owned by, State of Alaska, or at least some of the shopping malls, Tyson Corner and some of those places back in Virginia. It was my understanding that PFD had big holdings of that. Anyway, the chart that's in front of you right now on this slide is a chart of the Dow Jones Industrial. So the reason why people are involved, why institutions are involved in mutual funds rather than, just holding savings accounts or something like that, is because of the growth. You can't, that 45-degree angle, if you were to plot gold up against that or plot regular interest would be just a very shallow line that would be overtaken by inflation and be essentially flat. But just even the Dow, which is just a representative of quite a few um, industrial stocks, in this case, companies with industrial output, um, typically year to year, not every year, Great Depression back in the 30s and the whatever we want to call this thing in 2008 or 2007, the big real estate thing. This is, there's been some losses, but overall about 10% up. Now, the worst thing you can do, and this is why you got to make sure you have an appetite for investing before you get involved in stocks if you're going to be, buying and trading stuff yourself. If you're somebody who, is doing well, you're making money, and all of a sudden the market starts to fall apart, psychology is what it is. Nobody's going to sell at the top because you didn't know this was going to happen. And then this does happen. They're like, oh my God, I need to get out of the market. And they do, and they get out right here at the bottom. And, they never participate in this upward growth again. So if you're somebody who's right here and the market falls apart, guess what? It does come back at a certain point. So you had to wait a year or two. Actually, this is the Dow, so it's not necessarily representative. Um, I didn't lose any money because I didn't sell anything. But anyway, the next year, I think 2009, I made like 43%. I mean, it was just crazy. Now, if you take into account the losses from the year prior, I'm about flat. But that's fine. far better than having sold at the bottom. Sometimes you need to weather things out. But anyway, I'm not giving financial advice here. But if you hear about people getting clobbered in the stock market, it's because for whatever reason, they chose to sell at the bottom. So, buy low, sell high, not, anyway, sell low and buy high, which is what psychology will tend to drive you to do. All right. So stocks, mutual funds sell shares to individuals, and also, mainly institutions, mainly big buyers. Bond mutual funds, same sort of funds, but made up of bonds and professional portfolio managers. Can be. I mean, this is more the classic thing. Again, you can have an index fund where there's very little management taking place. They just buy and hold them. But the reason why you get in the mutual fund is, number one, for the ease of trading and all that, to push off those management tasks onto a professional manager, and then also for the diversification. So rather than just investing in one company or even one sector, and then you can also do specialty type things, and we'll look more at that in terms of what some of the mutual fund companies offer. Small initial investment. A lot of times they'll have maybe some artificially high minimum to set up an account, like say $2,500 or something like that. But if you opt to do regular periodic investments, say like as low as $50 a month, then they waive that. So yeah, you can get involved for quite small amounts and very flexible. You can have this taken directly from your checking account, some sort of debit if you like, or you can send them a check, or you can have it done through your payroll. And one thing we'll talk about is when you're working for an employer, a lot of times they'll have a matching type strategy, meaning let's say you invest a couple 3% towards your retirement, and they match it with another 3%. So that is an amazingly good deal. If you need to take advantage of that. If you don't, you're essentially getting paid less than your coworker. So whatever you do in terms of investing, at least get the match, so that you get the maximum amount of money from your employer. So let's say you're making reasonable money, you're getting $100,000 a year, and you've got a 3% or a 6% match. You could be making $103,000 or $106,000. If you don't, you're leaving money on the table. So make sure you definitely do that. Net asset value, what they do, rather than have a stock price, because it's made up of a whole bunch of individual stocks, and so obviously it could be done today with faster computing and all the other stuff. They could calculate the price throughout the day, but they don't. They calculate it typically at the end of the day, and then they report it as a single share price. And so mutual funds will have a ticker symbol, just like a stock will have a ticker symbol, and you can use the charts and all that kind of stuff. But the mutual fund people, they kind of get a little pissy, and they usually have some rules in place to prevent you from trading mutual funds on a quick basis. They don't like people bringing money into the account and taking it out quickly. So they may have some sort of, I've seen restrictions where you're limited to 3 or 4 transactions per month within a mutual fund, because they don't want you essentially day trading or doing quick speculative trades. They prefer you being there for the long haul. Open versus closed-end funds. This is just one facet. Mutual funds, they can make whatever rules they want. Sometimes mutual funds can be closed. But more and more, competition being what it is that some of these mutual funds with some of these requirements where there's a limited number of investors, or there's higher fees, or there's commissions charged, which in mutual fund parlance they call that loads. If it's a loaded fund, a lot of those have kind of gone away because they're just not competitive, especially since there's the time value of money. Since if they charge a commission up front, that's money that could have been worth a fortune had it not been paid in a commission. Now, if they want to do a back-end load, say when you sell the shares and they want to take their commission, I still wouldn't do it because there's funds out there that don't charge commissions like that. But if they, at least if on the back end, then they have some skin in the game. They get a higher commission if you get higher earnings. But anyway, not necessary on a lot of these. Now, there are some funds too that tend to limit things in terms of the number of investors or the overall fund size. I think Berkshire Hathaway might be limited like that, and a couple others might be limited because they become kind of the elephant in the room where they try maybe their strategies to invest in small companies. And they're this behemoth mutual fund. When they go into the market, when they buy a chunk of a company, they're just so large that they disrupt the company itself. And so the stock price ends up essentially being manipulated by this huge mega mutual fund investing in them. So there is some logic in keeping some of the funds specifically a little smaller. Here's another one, a closed-end fund that sells shares to investors but do not repurchase them, instead purchased and sold on stock exchange. Again, they can structure the rules however they want. I've never been involved in the closed-end funds. Load versus no load. So, yeah, if you're paying a load, you're screwing up basically. You're needlessly paying a commission. So there's a few companies with salesmen, and obviously salesmen need to be paid. They need that commission, so yeah, they're going to charge a load. So if you're buying your mutual funds maybe through an insurance company, if you're buying them through some sort of retail agent who's explaining the details to you, yeah, expect to pay a load. But it's not that difficult, and the mutual fund companies will work with you directly, and you can not have to pay that load, because this load can have a significant effect on the performance. Here's a guy, comparison returns from a load and no load. So starts out with $5,000, doesn't pay a load, so it's a no load fund, right? Amount invested $500. Bought the shares, ends up with $5,500, makes a 10% return. Not bad. Same guy, $5,000, pays a $200 fee. So he's already down $200. So only $4,800 gets invested. Buys that number of shares, and his rate goes down to 5.6. Now you extrapolate this out to a long term. The fact that this person actually has $5,000 invested, and this person has $4,800, especially on a long-term investment, that rate is going to be, anyway, just, you don't need to do it. Also, sometimes the expense ratios on some of these funds, there's some variables. Yeah, an average ratio of 1.5, and then there's some management fees and 12B fees, some marketing fees, some other fees that are involved. If a fund's got super high fees, it's going to be essentially like paying a load. Now, if it's a fund that's getting an extremely high return, because some of these mutual fund managers are essentially like, professional sports coaches. I mean, if you want to, if you have an NFL team and you want the very best coach, or even a college team, they buy those coaches as well. They'll spend a tremendous amount of money. If they're getting results, hey, that's money well spent. If they're not doing any better than the other funds, then you're wasting your time. So I would not, I would not just discount a fund because it's paying a higher expense ratio if it's getting the results. But if it's got high expenses and low performance, screw them. Go somewhere else. And it's quite easy to make comparisons with mutual funds, as we'll talk about. Funds with lower expenses tend to outperform, all things being equal. But if the fund with the higher expense ratios, and I'm not concerned with trends and tens, and I want to, I don't have to accept poor performance. I'll go on there and I'll find the best fund available. So I'm going to jump right now to just the internet just to show you a few things. So number one, you can go to these guys. This is the Mutual Fund Education Association. So obviously they're paid by all the different companies, mutual fund companies, of which there's quite a few, and maybe not all of them, but there's several of the big boys are represented in here. Anyway, Schwab, and some of these names you haven't really heard of because they're more institutional. If you're a pension fund manager, you probably know them. Fidelity's certainly a big one. Big insurance company, John Hancock, T. Rowe Price. Anyway, different companies. So let's look at one company here. This is Fidelity. So they were one of the ones listed. Investment products. In order to be competitive, most of these brokerage firms, they may have their own mutual funds that they offer, but they will probably offer funds from other companies. So why choose Fidelity funds? So they're going to push their own stuff, right? As they can. They're a private company. But they'll also have all mutual funds. And then the other critical thing is the 4- and 5-star funds. So, yeah, it's a competitive thing. Who cares if something's got a 2-star rating? You're not even going to look at it because it's not rated. Now, again, the rating. Do you want Fidelity to rate it? No, because they'd have a little bit of bias. So it's a Morningstar rating, right? And we'll come back to the Fidelity side. So this is Morningstar. What do? They don't actually have their own funds, but they rate the other companies. Now, again, it's a fee for service kind of thing. So they'll give you a little bit of information, but yeah, if you want the good stuff, you're going to be in their premium services. Fair enough. But these other companies, like Fidelity, for example, will pay Morningstar and then publish those ratings. If you want them from Morningstar directly, if you really want to go more in depth, yeah, maybe you might have to subscribe to Morningstar, but you can probably, get the data. So let's look at a few funds here. They'll again, you don't get too wrapped up and think, oh man, I really think that this one company is, this one sector is going to do. Try and verify it with secondary information, and maybe look at some of the charting here and the research stuff. Now, also keep in mind that any of these numbers, these are not forecasts, right? These are all historical data. So I would imagine, I think the stock market's going in kind of a rough time here. And so these numbers are probably not going to be, this positive. But semiconductors, go figure, the chip shortage. Yeah, so they've already up 35%. 1 year, 66%, 45%. I mean, those are good numbers, right? Here's all mutual funds. So, again, you could rate them and set up the charts. And all of these have got Morningstar ratings of well, essentially all these are 5 stars. And if you want to buy them, boom. I mean, it's that easy. It's quick if you had an account with them. Then they're also done by category. So, large growth, mid-cap growth. So capitalization is cap. And there's terms that equate to that. How many billions of dollars it takes to be a mid-cap versus a large cap versus a small cap. Diversified emerging markets. I mean, you can find all these Pacific Exchange, excluding Japan. I mean, you could you could spend literally hours in here. Now, if you hit buy, let me see. It's I don't know what's going to jump to my account or something. Yeah, it's going to want me to log in, or you would start up your own account. Not hard to do. They'll help you out with that. Another thing that's kind of come up that's affecting a lot of things right now is this ESG, environmental, social, and government. So you're seeing it affect the economies worldwide right now. It's huge effect right now in the EU because they may regret some of the decisions they made. I'm not, anti-green or anything, but they are gonna get clobbered this winter on energy prices because environmental, social, and governance reasons. They didn't invest very much in traditional fossil fuels, and although the green energy, sustainable stuff's going to eventually take its role, they're kind of doing more of a cold turkey approach here, and literally they're going to be a little cold this winter because they're having to buy natural gas at about a 600% increase over last year. So good luck with that. It's only not quite November yet. So anyway, but again, look through some of this information, see what's a good fit for you. Tons and tons of stuff. These sites are pretty much, all debugged. There's no errors. They're not clunky. They're easy to figure out. You can explore Morningstar stuff. You can, these guys are slick. They put a lot of time and a lot of money, and we could go to any one of these guys, Vanguard or Schwab or whoever, and just a huge, huge resource. I am getting a couple papers back. Everything, people are submitting some papers, and yeah, again, you're more than welcome to do that. These papers are going to be, each one is going to be like a snowflake. It's going to be very unique to you, and not necessarily you too. That's the other thing I've kind of said that I'm probably confusing you right now, but nobody knows where they're going to be 5 years from now, right? And I'm going with the paper for the typical college student that's in the middle of their college career or whatever, their education. But you're just going to make an estimate, and I'm not looking for your personal data. I don't want a bunch of you don't have to tell me any of the plans and privacy issues and all that. But what you want to do is you want to come up with some, maybe a mythical person, Bob or whoever. If you're female, you pick another name, but and try to make an estimate of this other person who is probably going to be in a similar situation to you. And you don't have to. You can use your your own name if you want, if you're comfortable in doing it. But I don't need your great amounts of your personal information. And to tell you the truth, when you're trying to guess 5 years out, you're probably not going to be all that accurate anyway. But at least you'll have some sort of concept to plan around. And things always get modified later. Things get changed, but you'll create this hypothetical person, and you'll say, they're in this career field that hopefully is pretty close to your most logical prospective career field, and it has the same sort of aspirations in terms of family and location and things like that. Let's say you're somebody who's done with Alaska. Yeah, I'm not recommending that you start some rental empire in Alaska and move away from it. You certainly could. I mean, I've been an absentee landlord in Germany for 10 years now, and it works out great. I don't have to clean toilets. I pay somebody else to do that. So those aspects of it, time management wise, is actually kind of nice. But anyway, tailor the paper to yourself. So there's really no wrong answer. You need to hit the content, the 4 to 5 pages typewritten. You need to cover the tasks that we have in the term paper, kind of a little bit of a statement on how this person would take care of their insurance needs, take care of their retirement savings, um, you know, has thought about taxes a little bit, how they're going to try to minimize taxes. And I don't minimize, I'm not saying like you're cheating the government, but the tax code is written for you to pay the least possible. They're trying to incentivize you into the behavior that they want you to do, and if you do that, then you'll pay the least amount of taxes. So anyway, hopefully you all are embarked on your paper and doing well with it. All right, back to the slides. So types of stock market. So we looked at a few in there, right? Growth fund. So growth fund is a company that's not paying a dividend. They're trying to get big. They're a smaller company or a mid-sized company that's getting every bit of their profits and investing it into expansion. And you, by investing in them, you're trying to make money by seeing that share price expand. Same thing with the capital appreciation funds. Yep, grow at a very high rate. So the grow, I mean, that's all about it. So small caps, mid caps, and there's actually numbers that equate to that. I'm not going to go into them because it's, numbers that we don't fathom very well, billions of dollars. Equity income funds. Okay, now this is not a growth fund. An income fund, equity is stock, so all stock funds are essentially, equity funds. But the income part is what the operative word here, and that means that it's paying a dividend. They're no longer growing. They're putting their paying their dividends back out to their investors to compensate them, since their share price is probably not going to be, doubling or tripling anytime soon. So they still want you to invest, and so they want you to remain shareholders, and so they're incentivizing that by sharing the dividend with you. Balanced growth. Yep. So, they can pick up some startup companies, some growth companies. Growth companies are, there's a higher propensity for failure when companies are emerging. Some of these old, stodgy companies are going to keep moving along. You get somebody like Ford that at one point should have been out of business. Actually, I think they were the one that didn't take money from the government. But anyway, you would not expect huge growth out of them. But you wouldn't expect them to go out of business either. Sector mutual funds. So we saw that a little bit on the page there. The sectors can be done in industry, or they can also be done, geographically. They can be done however they want. You can find funds that take that ESG concept to whatever levels. They will not invest in anything that deals with, practices that they consider, immoral. So anyway, it can all work out. Sometimes they may not be quite as transparent, or they may not have problems with certain issues, but anyway, you have to look at the underlying stocks. You can always go to a mutual fund, and if you click down deep enough, you can see what their major holdings are. And that's another thing about diversification. You may think, oh, I've got 3 different funds, and I've got the emerging growth, from this company, and the emerging growth from that company. But if you look at the underlying stocks, and it's all stuff like Alphabet, the growing, or the company from Google, it's maybe Tesla. You may not have much diversification at all because they all own the same stocks. So index fund, we talked about that. That's just a buy and hold type thing. They figure out what's in an index. That's an open information. They buy a certain amount from each company under that index, and they hold it. Very low management fees. International. So international means outside of the U.S. Global means everywhere. Socially responsible stock funds. So, yep, again, they can, divide things up. They could maybe avoid, maybe certain areas in countries that have labor practices that are wrong. They may be against fossil fuels, but again, where's nuclear fit into that? Whereas anyway, it has to align with your morals as well. Other types of stock funds, yep. And then ETFs. ETFs are exchange traded funds. So what happens here is these are mutual funds that essentially what happened was the stock market, the big exchanges kind of felt like they were missing out. How do these mutual fund companies basically get their product, repackage it, and sell it to consumers? So they kind of wanted to get in on the game. They want to sell their stuff directly and have it traded on their own exchanges. And these ones are typically meant to be traded more like stocks, where you can, do some of the limit orders and stop orders and other stuff to make it a little bit more exciting. Some of the crypto is now getting into the ETFs as well, where they don't actually own the Bitcoin itself in this case, or Ethereum, or whatever the underlying crypto is, but they have some sort of arrangement where it's tied to the price. So we already did this. Vanguard would be another company that you could look at. Be just fine. Similar to Fidelity, probably bigger than Fidelity actually. Mutual funds, so on bond mutual funds, again, these are, you don't own equity, you own a bond, which is essentially a loan, and they can be quite safe if you go with T-bills, but they're not going to keep up with inflation, and inflation now is, anyway. So, but if you're looking for a place to park money to at least get some interest out of it, better than like your bank savings account, you go with any one of these. So, Treasury bonds, government securities, Ginnie Mae would be against mortgages, and then corporate bonds. Now, corporate bonds are typically to be, companies do go out of business as opposed to governments that typically don't. So, again, you'd have to look at the rating agencies, kind of like the Morningstar, but for bonds. So you have different, Moody's perhaps, Standard & Poor's, somebody who's making sure that when it says a high quality firm that they don't have some sort of secrets. High yield is the same as a junk bond. So these ones, as long as you know what you're getting in on, you could perhaps do quite well. These companies are desperate. They're paying a great return as long as they keep paying the return. Munis, a lot of people get into that, especially if they're tax-free munis. And then index bond funds, where they don't, buy and sell the bonds under the mutual fund. Whoops. International, global. So now here they get in the international and global. That is the standard definition. Global means everywhere. Maturity classifications, you could stagger the maturities so that they don't all mature at the same time, so you have a broader delivery date. Mutual funds, so you get dividends if they are income stocks, capital gains if there's appreciation and they buy and sell these stocks, and then capital gains from redeeming shares if you sell at one price and go for another. Now the deal with some of these, you'll get mail from these guys around tax time every year, typically by the end of January, so that you can file the taxes. But if you tick the blocks when you're starting up a mutual fund, and generally it's advisable to tick the block to say reinvest, dividends and capital gains as they go. So if the manager is buying and selling funds under there, and you've ticked a little block, it should be fairly transparent to you, other than seeing it on the statement. If you don't, then you might actually get these, small checks. And if you just have a small amount of money in the fund, they would give you a distribution, which is typically not what you want to do. You're trying to invest money here. You're trying to grow that nest egg. So to take income from it, unless you're in some sort of retirement status, would be counter probably to your objectives. Okay, so here she's got an index mutual fund, technology mutual fund. So this one is paying a dividend. This one is a technology, so they're essentially saying it's a growth mutual fund. Most technology companies are in the growth sector. Short term, none here. Short term of 900. So you know that short term and long term are going to be taxed at different rates. Total income, tax on dividends, tax on short terms, and then tax on long term. So anyway, it depends on your setup. Here's taxes on short term gains on $252 because that was under held for less than a year. So yeah, the bite is going to be a little higher, and tax on long term would only be the 15. So anyway, it makes a difference, especially on stocks and mutual funds. If you've held it for close to the year, depending on your tax situation, in most cases it's far better to hold on to it for just a little longer. But there's some gamesmanship, because if the market dumps before you hit that 1 year point, you could be up for a less advantageous position. Risk investing from mutual funds. So the same market risk. You're in the stock market. You're across more companies, so that's better. But you're not immune from general stock market variations. Expected return and risk of stock funds. So many variables. If you're in a conservative fund that's not making much in terms of interest, you should not have the same volatility, the same variations. But sometimes you got to get off the porch and get the higher returns. Like I say though, for at least right now, it's market is looking a little dicey in terms of the big bull run that we've had. You have bears and bulls, and bullish means that things are going up in general, and bearish means that things are looking downward. So what you want to do is you can't say, oh, high risk is bad and low risk is good. It's the comparison of the return to the amount of risk exposure. If you have the potential for high gains, well, then there's going to be high risk involved. What you don't want some sort of situation that we had maybe back in 2007, where it was actually in the bonds, where they got all these crappy bond funds, they put them together like a bigger pile of crap, and they said, oh no, that this is safer somehow. No. And then they sold them as oh, these are people's homes. These are completely safe, when they were anything but. So anyway, you just want to make sure that if you're in something that's paying a good return, that it's that the risk is involved. The worst case scenario is to be involved in something that's paying a crappy return, a low return, but is exposing you to high risk. So you just want to make sure that they're balanced together. Investing in bond mutual funds. So yeah, the interest rate risk, where potentially there's other rates that are more attractive that will become available, and then if it's a private company, that they just go into default where they aren't able to pay. This can happen at the municipal level, but it hasn't happened as much lately. So this is what they're saying, and these numbers, I wouldn't put out a chart like this, because there's some index funds out there that can invest in the technology, the Russell something or other, where it's a technology heavy index. It can be higher risk. Index fund, income funds, maybe because they're larger companies. Foreign growth stock funds, well, Switzerland's a foreign country and it's not very risky, whereas whatever, perhaps Venezuela or something else, is hugely risky. So the one element that you have when you're investing in foreign countries is also the currency risk, where there's, you know, devaluations of the currency that can sometimes wipe out your profits. But you have to look through. I mean, there's global stock funds. It's a big globe. They can be invested in some really sketchy companies, or they can be invested in Canada and the U.S. and other places. Although the Canadian Stock Exchange, especially in the minerals sector, it's like the Wild West. It's probably one of the sketchiest exchanges out there. So anyway, you can't. It's tough to make generalized charts. So you have to do your individual research. Here's where they're saying interest rate risk of bond funds. So they're showing high versus low, and this is the default risk. So short-term bond fund, long-term bond fund. Well, the reason why they're saying it's high is because all these are in the high yield. So these are essentially junk bonds, right? And these ones are all with the government. T as in treasury bond. And this one, since they're going a longer term, they're committing to saying that interest rates are going to continue. They're trying to do a weather forecast for 2 weeks versus a weather forecast for tomorrow. It's obviously going to get a little dicier the further out you forecast. Risk from investing in a bond fund. So, yep. Like we said, longer term, default risk of the underlying company. And so you have the interest rate risk, default risk, or both. So short term and the government. That's going to be the most conservative. And down here, yeah, high risk junk bond. Potentially higher returns. So maybe a strategy where you've got 60% this, 30% that, and 10% high risk. That's one way to get your diversification. And if things are going well, man, you can make some money. This junk bond, if it works out, might pay off more than the others. But if it fails, it's only 10% of your account. So this kind of mirrors it. So again, you'd have to look at the bond ratings too. I mean, essentially they're doing that to a certain extent, where they're saying high yield is going to put it down in the lower rated bonds. And obviously the treasury bonds are going to be the lowest risk. But in some of these, and again, in the mortgages, you have to look at what the underlying assets are. Things have gotten maybe a little safer, but really the mortgage qualifications, it's just a lot more paperwork. But I don't know that they're still putting out a great number of loans, and it's not like the people have changed that much. The thought was that with mortgage-backed securities, that these are people living in their homes, and the last thing that's going to fail, the last thing they're going to do is not pay their mortgage because they will have nowhere to live. Well, post-COVID, a lot of people aren't paying their mortgages, and maybe not through whatever, just the circumstances. But it doesn't speak to the bonds being super secure when they're backed by mortgages that are being unpaid. So, investment objectives, risk tolerance, fund characteristics, and the prospectus. So when you buy a mutual fund, it's kind of like an end user license agreement where you got to read off or sign off to say I've read the prospectus. But you do kind of want to read the prospectus, or at least the first couple paragraphs, because it'll tell you what the plan is, where we're going to invest, what sort of things we're going to do in terms of we're going to use leverage, and so this is where it's helpful to know a little bit about stocks because then this stuff makes sense. You go, wait a minute, this guy's going to be using borrowed money. He's going to be investing in small cap companies that might fail, or you may say, giddy up. I'm looking for a higher yield, and I want this guy to be super aggressive, or woman to be super aggressive, whoever the fund manager. So read the prospectus and make sure it's aligned with your outlook. General goals, type securities, past performance. So just a single year, like, a great illustration of that is the semiconductor thing. Well, semiconductors, they're building what do they call them, fabs or whatever. Those things are being built all over the place right now. And, 3 years from now, it's probably still going to be growing, but maybe 5 years, this 60% yield, probably not going to happen over the long term. But there's no wonder why it's the top performing fund last year is because, there's a crisis. Money is being dumped into there. So you need to look at some of the underlying reasons for why a fund might be up significantly. Fees and expenses. So basically don't do the load. I mean, there's really no good reason. It's a competitive world out there, and loaded funds are just there's fewer and fewer of them offered every year. Redemption fee or back-end load. So again, a load that's charged when you go to sell. So it's basically a commission at the end. I wouldn't do it, but I would prefer it to a load on the front end, and then the expenses and management fees. Again, this is a balancing thing. If they're getting huge returns and they're trading and they're earning their money, then they deserve to be compensated. But if they're underperforming, screw them. They're gone. The amount of risk you want to tolerate, but again, risk and return are related. And then the dividends versus capital gains. So, an income mutual fund versus a growth capital appreciation mutual fund. It's all marketing. They'll come up with the best words ever. One thing they'll try and do too is they really love this concept of these life cycle or life whatever, and they want to know how old you are and when you plan to retire, and what they're going to do is they're going to move you. When you're young, you're going to be in these higher risk, high growth type funds, and then when you get later, mid-career, they're going to move you to slightly more conservative because now you're getting closer to retirement. And then when you're in retirement or getting very close to retirement, they're going to switch you to all these income funds that are going to be very secure, large companies, and pay you a dividend. And yeah, you can do that. They have them out there. I'm not a big proponent. I'm still in super high growth stuff because that's where the market was. The market was booming and everything was going well. They can put together a new mutual fund tomorrow, and I'm sure there will be there's always new mutual funds coming on the market. But if you see a life cycle fund where they want to know certain dates and stuff, that's sort of the strategy they're employing, and they do a pretty good job of selling it, and for a lot of people that works. Minimum investment, usually not a factor. The minimums are so low that you'll be able to buy them, buy and redeem. I'm kind of to the point where I'm more concerned about the identity and somebody going into the mutual fund. The mutual fund, the point of having a mutual fund is so you don't have to obsess about it every day. You've got somebody managing the fund and they're taking care of it. And I'm not saying you're going to ignore it, but you do want to have some security around that fund so that you don't find that somebody, executed some telephone transfer or some, online transfer and you got cleared out 2 months ago. So, yeah, I'm definitely into two-factor authentication, all the rest of that on when there's large amounts of money involved. So now again, if the company is talking about faxes and we need a fax for this or a fax for that. They're probably not the kind of company that you want to be dealing with, since their technology is probably lacking. You want to. It's a fine balance. Making the decision. So narrow down your choices. Consider the mutual funds. Again, we already went to the Fidelity site. Now they're going to go back and look at the quotes. Again, just like that same Yahoo Finance or Google or whoever you're using, they would do the same charting based upon the ticker. And rather than say stock price, it's going to say net asset value. Who cares? Anyway, net change, annual return, dividend if it's an income fund. We looked at the Mutual Fund Education Association. Diversification. Yeah. This is like, let's say you're going to diversify in real estate. So, yeah, I want a good house and I want a crappy house and I want, no, you don't. You want all good houses. Maybe you want some rental property. Maybe you want an apartment. Maybe you want a, single family home. But to say, oh, I want to diversify against stock and bond mutual funds, for the past 5-10 years, bonds have just not been a good way to go. So don't diversify for the sake of buying something that's underperforming. I'm all about diversification, but diversification across the best assets. Maybe if you're super heavy in technology, maybe you want something else, maybe energy or banking or something like that. But anyway, and then I talked about sort of the false diversification where you own, 5 different mutual funds, but they all hold the same underlying assets. You don't have diversification. Diversification among mutual funds representing different countries. So certainly you could do that. Again, though, don't be under the, there's certain countries, and this isn't, a nationalistic thing, but the United States is still pretty dominant. So when the United States economy goes in the toilet, it's, the saying is when the United States gets a cold, the rest of the world, coughs or sniffles or whatever. Most of these markets are driven down uniformly together because we're in a global economy at this point. Impact of the financial crisis. So, yep, limited effectiveness. Most mutual funds, they all went down together. So, and gold didn't do any better. So, now that we have crypto, that's changed. That's a different thing. That's a new element since that crisis happened. Yep, you could do that. Anyway, it's all marketing. They'll set it up to whatever and try and sell you on it. But again, look for third party, Morningstar or even maybe not Money Magazine, but some other financial basis. And we all know that there's people on the internet that will, act like they're evaluating something when they have an interest with that company. So you have to look for objective advice. Yep. We're not learning a whole lot here. Obviously, the funds are going to equate to the country that's underlying it. Hedge funds. So you can find some mutual funds out there. Now, normally these are kind of high wealth kind of guys, but you can find mutual funds that are super aggressive. So if somebody says, "Oh, I'm going to be very conservative. I'm just going to invest in mutual funds," that's not an accurate statement. There are very conservative mutual funds, and then there's some that are out there just pushing it up and doing, hedge fund type tactics where they're leveraging and doing all that kind of stuff, and they step away from investing and they're more into speculation. And hey, if they're good at it, that's where they're going to make a ton of money. But that's where also they can lose a lot of money. You know, you start involved in SPACs and some of the other stuff, and you know, it can be highly profitable, but it can also be, you know, devastating if things go the wrong way. So it's hard to classify. Bernie Madoff, this guy was he's a sleaze. But this gets back to what I was talking about, where these people, you know, they're essentially getting around 20% year after year on the investments that this Bernie Madoff was making for him. And it was all risk-free. Well, you know, they weren't thinking. You can't be getting 20% yield in a risk-free environment. That's not going to happen. What he was doing, it was a pyramid scheme. He was taking money from the new investors. You go give him $10,000. He doesn't invest it. He splits it all up and he gives $2,000 to all the old investors and tells them it's a return on his investments. The new people, you know, obviously they're not expecting a return yet, but when they do get a return, they just get the next guy who came in, and they get all that money and they give it away to the next level investors. Well, as the pyramid grows, I mean, Bernie obviously gets rich, and at a certain point, you know, the house of cards kind of falls because Bernie hasn't been investing money. He's just been shifting it around. So that's a pyramid scheme. And if people would have done due diligence, and they would have figured it out. But anyway, it didn't happen. Homework. So would you prefer a taxable investment getting 10.2% or one earning 7.9%? So we'll look at that in a second. Here's a stock price problem, and here's an interest rate. What happens? Obviously, when interest rates change, the desirability and the amount of money you can sell your bond for is affected. And here's one, just a kind of a word problem, not a big deal. So I'll look at this first one quickly. You can almost do this in your head. So this guy is going to get 10.2% on a fully taxable account. So it's great that he's getting 10.2%, but he's in a 28% tax bracket. So he's going to be paying essentially $280 out of every $1,000 made in taxes. Or another way to do it, his yield is going to be 28% less than this stated number. So if I wanted to multiply, well, since it's 10% or nearly 10%, we can almost just subtract it and go with around 0.72, where he's going to be getting about 7.2% on a fully taxable versus 7.9 on a tax exempt. These numbers are kind of artificial. Normally the tax exempt ones don't pay 7.9. But anyway, if I was to I worked through that kind of quick and just in my head, but the numbers are going to be pretty damn accurate. If you wanted to be a little bit more accurate, you would get 100% minus 28%. That would give you what? 72. So 72%, if you go 10.2% times 0.72 or 72%, you would get that number that I was talking about. That's just a little over, let's say it's down around 7.3. And that's how you do it. So just quickly to get a calculator up here. So 10.2 times 0.72, which I think we can all agree is 72%. 7.3, so close enough. So which interest rate do you want? 7.9 or 7.3? So it's pretty useful. this sort of logic is the same thing that applies when somebody says, "Oh, you need to donate with us because it's tax deductible," and they act like tax deductible and tax credit are not the same thing. If you do something very nice, like give money to whatever, let's say you adopt a child or you do something like that, and you get $1,000 tax credit, and you owe, say, 30 grand in taxes, and you get $1,000 tax credit. Did I get that wrong? Anyway, you'd owe 29,000 in taxes. But let's say you give $1,000 and it's tax deductible, and you're in that same 28% tax bracket. So you give $1,000 and it's tax deductible. So boom, obviously it's easy math there. You saved $280. So you're still out of pocket. The $720, right? You made a $720 donation to that company, of which you got $280 back. So you made $1,000 donation, of which it only cost you $720. So I mean, I'm not saying not to contribute, but you can use this same logic to explain tax deductible versus tax credit versus different interest rates. So you'll normally find, say tax-free munis paying down a couple percent, 3% or something like that, and people will just glom onto it and say, "Oh, I want the tax-free one because it's such a better deal. I want my taxes to be lowered." And with just a little bit of simple math, they could have figured out what it actually was and done it on quite a bit better analysis quite quickly. So anyway, that's it for today.